Good morning. Welcome to our 10th annual CFO Forum. My name is Jane Rodriguez. I'm with the Office of Advancement. I manage our global events portfolio, so welcome to our first virtual CFO Forum event. This year's event was especially fun to plan, and I would like to thank our co-chairs for the CFO Forum Advisory Board, Alan Beatty and Ray Young. Many thanks for your dedication and planning for this year's event. Today's agenda includes fireside chats, a breakout session, school updates, and more. We have built in two 15-minute breaks in today's program, at which time the meeting will be left open, so you're welcome to take a personal break or join your fellow alumni in an optional breakout room. Throughout the program today, we will encourage networking and active participation, so please keep your video on and use the chat to ask questions. You will manage your own audio and video, so please be mindful of your mute and your unmute settings. If you'd like to rename yourself with your full name and your grad year, please feel free to do so. Also, be happy to announce where you're coming from in the chat if you'd like to let your fellow CFOs know where you're residing today. Thank you for your time today and your support of the CFO Forum. I'm going to turn it over now to Randy Krosner, our faculty sponsor and director for the CFO Forum. And as most of you know, Randy is the Deputy Dean for Executive Programs, and he is the Norman R. Bobbins Professor of Economics. Randy, kicking it off to you to get us started today.
All right. Thank you very much. I'm really delighted to be with you. I know, of course, it is virtual rather than in person, but at least we're meeting this year, unlike last year because the pandemic had just struck, and so it really wasn't feasible to get together to have this happen last year. But I'm really glad that we have it this year, and I think one of the silver linings of the tragedy of COVID is that we have moved ahead technologically. And so it's going to be easier to be able to engage in conversations throughout the country and throughout the world with technology. And we certainly look forward to having lots of in-person activities, but also we probably will end up having some forms of hybrid activities. And I also look forward to welcoming you to London when everything opens up. The UK is making good progress on the vaccine and has a as Boris Johnson calls it, a road to freedom. And he says it is a one-way street because there certainly have been a lot of U-turns in the last year in policy. And of course, we have experienced all of that in the different shocks and unexpected twists and turns of the way the virus and policy has come. But hopefully we're on a good path in the US, UK, and globally for dealing with these tragic challenges. And that obviously is going to be a theme for the CFO Forum for today. So we're extraordinarily pleased to be able to start off with a fireside chat with Hugh Johnston from the class of '87, and who has been a longtime Chief Financial Officer at PepsiCo. Of course, PepsiCo is really, I think of it as kind of the global bellwether of consumption. PepsiCo, having more than $60 billion of revenues, is seeing kind of core consumption around the world. And I'm going to be talking with Hugh about some of the challenges of the pandemic and the future of the CFO. Then we will move to the breakout sessions, and Steve Kaplan will be leading us through a discussion of corporate social responsibility. Last year we had the 50th anniversary of Milton Friedman's famous essay on corporate social responsibility, and we did a virtual global conference at Booth commemorating that anniversary and discussing what that means for today. And that's exactly what you will be discussing in the in your breakout sessions that Steve will be running. Then we'll have another fireside chat with Stacy Frank, and I'm really proud because Stacy is one of my students, and she is the Chief Financial Officer of the Chicago Symphony Orchestra, and I'm on the board of the Chicago Symphony Orchestra, and we have dealt with the pandemic I think in a stronger way than most people had expected, and a lot of that is due to Stacy's spectacular leadership. So we're going to be able to talk about that, and then we'll finish up with Madhav Rajan, the dean, and myself discussing the future of the MBA. We had a lot of questions from the steering committee as well as others about, well, what does all of this mean for the school and for the MBA more generally? And so we'll have a half an hour there. So hopefully we will not have Zoom fatigue. We've tried to mix it up and have different types of approaches, have it really focused. And now what I want to do is move to welcome Hugh. As I mentioned, the CFO of PepsiCo and now vice chairman of PepsiCo also. And please make sure to send your questions in. I will try to mix them in as we're having our discussions. And Hugh, first I wanted to thank you so much for joining us. But as I said, PepsiCo is kind of the global bellwether of consumption. And man, did we get a hit in about a year ago. So I'd love to sort of start off there about how you dealt with this shock that we'd never had before.
Yeah, thanks, Randy, and nice to be with all of you, all of our terrific Chicago grads and CFOs out there. Boy, your word shock is exactly right. I mean, if you go to middle of January, there were very few people talking about this as sort of anything other than, boy, maybe it's like SARS a little bit. Yeah, it's a little bit concerning, but not much beyond that. At least no one in the ecosystem I operate in. And 6 weeks later, we basically were shutting down offices, creating new ways of doing business operationally with our frontline workers, the people working in the plants and then on the route trucks who bring the product to the supermarkets, and just basically replanning the year in its entirety. One of the way we did that was we sort of set down a set of principles and said, okay, these are the things that are non-negotiables, and we're going to compete. We're going to service our customers. We're going to protect our associates. And then everything else is fair game in terms of how we operate. And as a result of that, we actually kind of refigured out how to run the business. Q2 of last year was rugged. I don't remember what we were down, but revenue was down, profits were way down. By the time we got to Q3, we were delivering something on the order of about 4.5% revenue growth. And by the time we got to Q4, we were at actually close to 6% revenue growth. So the core consumption was always going to be there. People have to eat and people have to drink, but sort of figuring out how to operate in a new normal probably took us a good 2 months. And for all the scenario planning and risk planning we do, pandemic was unfortunately not on our list of things that we were prepared for. So we had to kind of figure it out on the fly.
What would be one of the key lessons for thinking about scenario planning and risk management going forward from this?
I think the biggest thing in all of it for us was really arguing about and figuring out what are the principles that we're not going to violate. Because once you sort of lay down that set of non-negotiables, then you can basically be flexible about everything else. And doing that as a senior team, I think, is important because as the CFO, you're going to look at it with one set of lenses. The customer guy is going to look at it differently, the marketing person differently, the human resources person differently. And being able to have that debate and in an open and in a transparent way, at the end of it, there was frustration, but as we got to the end of it, getting that set of principles, frankly, made the rest of it easy because then the entire organization knew, don't touch this, but all these other things are fair game for us to be thinking about. So I think that was probably more important than any tactical work that got done. It was getting that leadership tone. Really, I would call it almost pitch perfect in terms of the way we landed it.
Well, that's great. And I think that's extremely important because I think a lot of people spend a lot of resources trying to predict the next pandemic, basically try to predict the unpredictable. And that just doesn't seem to make a lot of sense to try to do something that's such a low probability event. But you can prepare for the unpredictable by having structures, by having principles in place. And so I think that's an extremely important lesson about thinking about having the structure, the framework. It's not about the particulars of the shock. If you have the structure there, you can then move forward.
That's exactly right. And the other thing that we did have in place, which I think most companies do, is essentially a crisis committee set of protocols. And we've actually gone through and reversed them for various things. Something were to happen in a country or something were to happen in one of our facilities, you know. So we had sort of a process in place that enabled us to sort of, okay, let's activate this process. Job one on this one, we all agreed pretty quickly was the principles. But without having had that in place, I think we would have probably been struggling quite a bit more to figure out what to do.
It's pretty impressive that you said it only took you 2 months because PepsiCo is a pretty large organization that's been kind of doing the same thing as most companies have been doing for a long time. So take us through a little bit of moving from the principles to the practice of being able to drive that transformation.
Yeah, I mean, the biggest one and the one we started first with was protect our associates. Because frankly, for one or two reasons. Number one, you really just sort of have a moral obligation to do that anyway, right? As a company who's putting people into manufacturing facilities or putting them out, in the supermarkets. Or recall our business is such that we deliver the product right to the shelf. So we were, going into the market, we were there with whomever else was in the store. So that one sort of began with, okay, what do we need to do to protect our associates? And it was primarily around first personal protective equipment and those types of things, so that you could, in fact, make sure that you could operate as safely as we all knew based on the advice we were getting at that time. The second thing that we needed to do was, okay, this is a dramatic change. People have children, they have family lives. How are they going to operate given you have a lot of two-income families and need to be two-income families? So it's right. What type of childcare thing do we need to put into place? And frankly, relative to benchmarks, we over-indexed on that one because we knew that was an obstacle that could actually drive, frankly, a lot of challenges for us. I mean, our biggest fear pretty quickly on this was absenteeism, because without having those frontline workers, we're out of business. We can't get to the store. They're critical to our operation. I've often joked about the fact that if senior management disappeared, not much would change for 6 months. If the front line disappeared, things would change tomorrow. So it really is the mentality of the company. So sort of getting through all that. And then the third piece was figuring out, what do we need to do with our customers? We credit was going to be an issue. The way that we operate was going to be an issue because we do intersect at the store level. So what were the things that we need to do to operate successfully with our customers? One of the next pieces was, how do you talk to consumers? Because if you recall, at that time, people were afraid. They were concerned about what does this all mean for them? They were afraid for their financial futures. They were afraid for their health futures. They were afraid for their parents and children and the like. So in that sort of dramatic shift in mindset, us running a happy ed with a bunch of people eating Tostitos at a barbecue would have felt ridiculous. So we really had to sort of make a lot of changes in terms of our consumer communications. And then from a finance function perspective, a little closer for all of us, we had to figure out how to work without being in offices anymore. Zoom has been a wonderful tool for us, Zoom and Teams and the like. But in addition to that, it was, okay, how are we going to sort of run our meetings? How are you going to do a quarterly close? How are you going to do a forecast? How are you going to do an investor call? How do you do a set of investor meetings? All of that stuff we had to kind of figure out as a finance function on the fly. And thankfully we were able to do it reasonably well. And, we had no issues with closes. Other than on one of our earnings calls, you could hear my dog barking in the background. We didn't have a lot of problems with earnings calls. And we managed our way through it. But it was an incredibly busy time, I'll say it that way.
Yeah. No, I think those are very, very important points because I think things that we never thought could be done virtually were done virtually. For example, there was a record amount of debt and equity that was issued. We knew that you had to do a roadshow, and the issuers have to confront the investors eye to eye, meet with them. Otherwise, you can't issue large amounts of debt and equity. Well, turned out that wasn't true. We could transform. One of the questions that just came through on exactly this issue that we're talking about the office came in from Ray Young. Do you think you'll be going back to the office? How do you see that going forward? Is this going to have legs, or is this something that, well, whew, we got it over with, we'll just go back to business as usual?
No, I think the office has permanently changed, and we're already out with our employees talking about it. So we've sort of put down a marker on this one. we're going to give managers flexibility to some degree, but no one will have the ability to mandate 5 days a week in the office. And in fact, what I expect, particularly for finance and IT and the functions I'm most directly responsible for, I think we'll probably have people in about 2 days a week.
Two.
Just, yeah, two seems to be about the right number. Now, I think for people who work in teams more frequently, say innovation teams and things like that, they're probably going to find themselves in the office more. We did make it clear it's not employee choice, it's manager choice in terms of what it is. So the company has maintained control. But I think we can actually get the work done with a couple of days a week in the office and then people working from home. One of the beauties of this has been commuting time. You know, even if you're on a train or something, it's kind of wasted time. It's better than it used to be because of the ability to sort of use devices. But compared to just, you know, getting up, doing what you need to do in the morning and then getting right to work, you're basically using or clawing back a lot of what was previously pretty unproductive time. And we've studied it through some of the telemetry tools that we have with the technology. As far as we can tell, we're picking up about 2/3 of that time, and the other the employee is keeping. So from that standpoint, it's making us more productive. There's a few challenges. New employees are a challenge for sure, because you know I literally had, because of a global business services initiative we launched, I've got a couple thousand people who have never met another PepsiCo person, and they've never set foot in a PepsiCo office in their life. Just they have no idea. So for those types of people, you want to figure out a way to get them into the culture. You want to figure out a way to have them build relationships. So I think it's 2 or 3 days a week is probably going to be the landing spot from what I can tell for most companies. And I suspect if you fall much outside of that, you're probably going to be at a competitive disadvantage in trying to get talent.
Yep. Yeah, this I think is one of the big challenges. We have the same thing at Booth. The people who were hired about a year ago who've never met any of their colleagues, who've never been into to the business school. It's really quite amazing. Another question came in about during this period. Did you suspend CapEx because there was so much uncertainty, or did you continue to move ahead?
No, in fact, kind of the opposite. We sort
Hmm.
of saw a competitive opportunity here to drive growth in particularly in our foods business, and as a result, where we had projects that were looking marginal, suddenly the marginal looked more positive than it previously had. So we leaned in as much as we could while operating, you know, safely from the standpoint of associates. From a cap markets perspective, you may remember the debt markets really kind of shut down for about a week or 10 days. We and AT&T actually led the debt markets open. We did about a $6 billion offering, really the first day that you could go out big, and it was oversubscribed, extremely successful. We're an A+ rated, A+ A1 rated company, and we use a couple $1 billion of commercial paper. Because of our strong cash flows, we're viewed as a very secure credit. So in a lot of ways, I like to think with John Stevens down at AT&T, we sort of set the tone back for the markets to say, no, companies are back in business. We're still borrowing money. We're still doing things. I think it sent good messages anyway. It gave a vote of confidence to the economy.
Yeah, I think that was a crucial turning point, and obviously the Fed's intervention to provide liquidity to the system to cut rates to zero was very important in getting rid of what I often call the market dysfunction discount at that time when the Treasury securities markets weren't working. And if people can't sell securities, they're going to sell everything very quickly, and that's not so good for for the markets. Got a number of questions coming in about. With the savings from travel going forward, how are you going to think about what priorities you're going to have for allocating resources going forward?
Yeah, a lot of it, we invested back in the business right away during the course of last year. To me, there are a couple things going on within our thinking. Number one, when we changed CEOs, we also, I won't say we fully changed strategies, but we altered our strategy to some degree. Under our prior CEO, the focus was really more on returns and margins. The new CEO came in and pivoted the value creation model a bit more towards growth and requiring with that growth somewhat more capex, which obviously short-term returns take a bit of a hit. And we made a couple of M&A deals. So we were already in this mode of we're investing back in the business with the goal of, rather than holding market share, actually gaining market share by being able to compete on advertising and compete on customer service and the like. In terms of the travel savings, frankly, they went right back into the business. I think our travel was down about 90% maybe year over year, because we had a couple of months of a bit of travel last year. And the number that we landed on was, okay, of that down 90, we're going to keep most of it. Versus 2 years ago, what we set our budgets for this year was basically 25% of what it was 2 years ago. And I expect we'll probably maintain that, if not beat it by a little bit. PepsiCo as an organization, in fairness, has always over-traveled relative to most companies. Culturally, it was just as biased towards traveling. And I've been trying to wring it out of the organization anyway. And basically all of this has sort of given me a tremendous tool to do it. So I think we'll be no more than a quarter of what we used to be.
Interesting. Now, in talking about CapEx and moving forward, you've gotten into a very innovative partnership with Beyond Meat. And so I'm interested to hear that about the decisions, because this is, a super uncertain time, and you're moving into an area that is very different than where you had been before. So how did you think about that, and how did you get there?
Yeah, I mean, we're looking for growth wherever we can find it, if we think there's value to be created. And plant-based protein right now is certainly a good growth area. We think a sustainable growth area as well. And we had a choice. We could have built it out ourselves, but frankly, that would have taken several years. It's not our expertise. We would have had trial and error. Or we could have partnered with the guys who really have the industry leading R&D capability. So the decision we made was we think we can yield more value by working faster and also working with high expertise by sharing, rather than trying to do it all ourselves. So we crafted this joint venture. So far, so good. I mean, all we're doing is formulating products right now. I will say one of the guys who works for me, who is just a tremendous meat eater, like world-class meat eater, he tried the products and he called me up. He said, "These are delicious. I mean, I really like this." So I think we may be onto something here. It'll probably be 6 months or more before we're out in the market with them, but I'm optimistic about the products purely based on his recommendation.
That's great. Yeah, I still haven't tried them yet. I'm a very traditional meat eater. I grew up in New Jersey. Plants were something that you kind of drove over as you're paving the roads rather than eating them. But I think I'm going to be coming around. I look forward to trying some of those products. Some questions have come in on thinking about the office culture and the corporate culture. Getting back to what you're talking about. How do you communicate in this realm? Because there's a lot of concerns about Zoom fatigue, about people being exhausted from so many emails, from people not only taking the extra time from their or the time that they would save from commuting, but now people just feel that they're just constantly on call because there's no distinction between work and the office. So how do you deal with communication, and then how do you deal with that sort of fatigue? And then how can you build your culture, especially with newer people who may only be coming in, a couple of days a week?
Yeah, I mean, the new people piece has certainly been a big challenge, and all you can do really is sort of what you normally did anyway, in terms of encouraging them to do one-on-ones with lots of people and checking in with them frequently. You just have to over-index on it for a while. So we did do a lot of that with new employees, just to make sure that we give them the maximum chance of having success with their onboarding to the company. In terms of the broader question of how do you manage Zoom fatigue and all of that stuff, one of the things I've done is I make it a habit to cut almost every meeting short. So, I mean, people are in the habit of booking these hour meetings, and frankly, I hate hour-long meetings. It's just, I rarely need more than 15 minutes to get through something, especially if you have a pre-read. So a half an hour if it's a complex topic, but an hour to me is just an awful lot. So uh, kind of keeping the meeting short, crisp, and to the point, I think has helped a lot. It just sort of trims down the meetings. In addition to that, a lot of us have sort of agreed among ourselves, hey, let's try to stay away from sending emails at off hours as much as we can. Occasionally you have to, and one of the things I found useful in the Microsoft Exchange function is that draft folder, where I'll just do a whole bunch of emails and put them in draft, and I won't send them till the next morning, because I do like to do emails at night. But at the same time, I know there's people who just, they can't help themselves. They can't resist coming back right away. And if you're constantly interrupting their nights, over time it's going to have a wearing effect on them. So for me, it's just put them in draft and send them in the morning. Now I have gotten complaints on the other side saying, why am I getting 8 emails from you at 8 o'clock in the morning? Can't you send them? And I'm like, sorry guys, you know what? This is a decision I've made. I think it benefits most by virtue of me doing it this way. And for the most part, I think people have sort of gotten used to it and appreciated it. The Zoom fatigue thing, I think, is an issue. And that's why I think a couple days in the office will probably be about the right balance. So for most people, it's, okay, I'm going to get to be with my colleagues. I'm going to, where I need to do real good one-on-one, face-to-face type work, I'm going to have the ability to do that. But I think there was also a lot of yield loss in the office, sort of, socializing and that kind of stuff, 15 minutes here, 15 minutes there. And I think for a lot of people, while they enjoyed it, they probably did it more than they needed to. And this is sort of giving them the reason to not do that. So I think it's going to balance out okay. I expect an evolution on this over time, and we'll do it. We'll learn, and maybe we need to be in a little bit more. Maybe we need to be in a little bit less. We'll figure it out as we go.
Yes, hallelujah on trying to make meetings shorter rather than longer. And also, as I think everyone at Booth knows, I loathe PowerPoint. And in general, and I think it's a real problem when you put it on these screens and then people just read through it. It just drives me crazy. And actually, when we were preparing for this, you had talked about how you think about managing your employees, and I'd written this down, and I really like the way that you said this. Say, tell me what I need to know, not everything you know. And so, could you elaborate on that?
Yeah, I'm happy to. But by the way, I agree with you on PowerPoint. If people send pre-reads, we actually now have adopted the feature of, no, don't put that up on the screen. We want to be able to see each other. I used to actually say that I think we should take PowerPoint off of every machine in the company. But since then, I've joined the board of Microsoft, so I tend to take to that now. Yeah, it's interesting. I mean, you probably all find it, and it's a little bit of a challenge, I think, for finance people. Oftentimes, is they feel the need to sort of show you that they've done all the homework and they've done everything, and they want to show you every analysis, and they're proud of it. And with younger people, I'll give them a little bit of leeway because they don't get access to senior executives all that often. But for my direct team, my answer is often more than anything, look, I trust that you've done the work, and I trust you're giving me the right information. You don't need to prove it to me. And my direct team is a team. We've been together, almost all of us now, for 8 or 9 years. So there's a high level of trust. There's a high level of confidence. They interact with each other well, so I don't have to sort of manage every interaction between the silos. As a result of that, it enables these efficient meetings, but it also enables us to get all the posturing out of the way. Because a lot of times when people put together PowerPoints, when people are coming in and they're telling you all this stuff, what they're really doing is trying to steer your mind towards their agenda as opposed to the company's agenda. And my push is constantly back towards, look, we need to basically focus on what are the big opportunities here? What are the big risks here? And now let's have a conversation about that. If it's day-to-day doing your job, I trust you to do it. If you do it really well, you're going to get rewarded. If you don't do it well, at some point, we're probably going to encourage you to find something else that you do well, either inside or outside the company. One of the other things, and you and I talked a little bit about this before, Randy, as well, this notion of sort of these functional silos. I expect some of you all run into this where, Treasury has their view and tax has their view and control has their view. Frankly, I have little tolerance for that stuff. My purview is too broad. The company is too big. And I've essentially set an expectation among those folks, and it's all of the corporate direct reports. You will work together and you will figure out problems on your own. And coming to me is a bad outcome. Now, if you have to, that's fine. And then I'm going to judge whether you really had to or not. But my expectation is you work as a team without me. I don't need to be the spackle that sort of binds together all the entire wall. And it's worked really well. I mean, these folks are phenomenal. They collaborate well together. They know each other's biases. They know each other's hotspots. They figured out how to work as a team without me, which is great because as CFO, as you all know, you have so many outside things to deal with, whether it's investors or agencies or all the stuff that's sort of outside the company. the less you have to spend on inside the company things, the less time you have to spend on inside the company things, the more effective you are.
Yeah, we just had a comment come in, which I think really well encapsulates this. Jonathan Hall said, "Trust is a fuel for efficient teams," and I think that's exactly that's really, I think, really gets it, because you want to delegate things out. Also, in what you said of "tell me what I need to know," I think that's really good training for people, because they need to think about not just, "Gee, I did all of this stuff," but if I want to move ahead in the company, I need to think about the bigger picture. Well, what is it that the decision maker, what is it that the person above me really needs to know? And so that'll make them much better as they move up in the company. So I think that's extremely good training. That's kind of how I think about it when I'm trying to develop people at Booth, to get them to think about what is it that I need to know, or what is it that Madhav Rajan needs to know, or the university president needs to know. And that's a really great way to see whether people can move to that next stage or not, or to get them trained to think about that.
Yeah, absolutely. I mean, if you think about it, early in your career in finance, you really sort of you make your mark on insight and detailed analysis and being able to sort of really analyze a problem from every angle. And that's great. I mean, that develops your analytical ability. And to me, analytical ability is still the core skill for CFOs and for finance people, generally speaking. It's the number one thing you have to have. If you don't have that, it's awfully hard to be successful in that function. But as you migrate to the more senior levels, you start to figure out you really get paid for different things. You're not getting paid for doing analysis anymore. You're getting paid for judgment, and you're getting paid for building and running a team that can actually do all the things that you used to do. Getting people to sort of make that transition, first transition to manager and the idea of getting work done through others. And then second, recognizing you're getting paid for your judgment and your ability to distill messages down to what matters, it's a hard transition, but it's frankly, it's a job requirement, as you all know, as CFOs. And teaching your people how to do that is, I mean, it has massive leverage on your time, right? It's just a force multiplier in terms of your impact.
So now I want to pivot to both some questions that we had gotten in advance, and that's something that I know has been a transformative thing that you have been doing at PepsiCo, is thinking about the future of the finance function. So the future of the CFO and the future of finance. So could you tell us a little bit about how you're thinking about the next steps?
Yeah, happy to. I mean, if you think about where finance has evolved over the last 10 years, technology has been a real enabler for us, right? Whether it's big IT systems like SAP and the like, whether it's leveraging, Excel and all the sort of tools that are out there. But as digital sort of accelerates even further, to me, we're going to go through a dramatic change in finance and how finance is done. The way we're trying to do it at PepsiCo, we just finished off an initiative. It probably took us about a year. It didn't need to take us that long, but frankly, I let the team do a lot of it because I wanted them to own the outcome more than, this is me dictating things from on high. We sort of distilled down the function into what are the four roles that we want to play. And what we settled on were, number one, we want to be sort of the navigator. So sort of helping to move the strategy along. Ultimately, the CEO's job is to decide strategy, but we can be enablers both in terms of shaping what's in the CEO's mind in terms of the strategic choices that he wants to make, or alternatively, helping him take the strategy that he settled on and making sure it gets driven through the organization. So this notion of navigating to us was very important. The second was, as a part of strategy, oftentimes there's big change that needs to happen, whether it's organizational change or whether it's operating change. And as a function, because we have a purview of seeing everything, we can be catalysts for that, whether it's using benchmarking as a tool to see where we over or under index versus competition, or whether it's sort of having a worldview on technology and how it can change our operations, or whether it's sort of looking at internal G&A and saying we have too many layers or too much cost or whatever the case may be. So catalyzing was a second big one. Our general managers love it when we do that work. It adds a lot of value to them. They think it's some of the best work that we do. The third is this role of integrator, which to me is sort of the day-to-day performance management type of stuff. And it's where most companies have a lot of people. We, as PepsiCo, we have way too many people doing that kind of work. And I inelegantly at times call them spreadsheet jockeys, where they're basically just doing a lot of Excel work. And we haven't standardized and centralized a lot of that work. And the important thing here to me is, by virtue of standardizing it, you can do two things. One, you can move more of it into a global business service type of center. And number two, maybe more importantly, you can actually start to leverage artificial intelligence to do a lot of that work for you, particularly in the area of forecasting and planning and those types of things. We've got a partnership right now with Microsoft where 18 months from now, I expect to basically have forecasting almost entirely done without human hands touching it and only on an exception basis. And I know by virtue of doing it that way, you take all the human bias out and all the sort of organizational biases out. The result of that is the number of people doing integrator type work is going to shrink dramatically. And I'm hoping most of them will move over into either Catalyst or Navigator or both, those sort of areas. For some people who can't make the transition, we're going to have to see where they go. And then the last piece, of course, is stewardship. So it's sort of the control side and making sure that the books are done right. We're doing all the things that we need to do from a reporting perspective. That type of work, I think, is just the way it's going to change is by virtue of standardizing it. Again, we can automate it using bots and things like that, and frankly, just be more efficient and more accurate with it over time. So it's a major transformation initiative for us. The control side, we're probably 30% of the way in. The planning side, we're probably 10% of the way in at this point. So huge initiative. I think it's going to be a game changer for the way the function operates.
I think it's really important to be on the cutting edge of using the technology and seeing where it can help, and then using your resources for the things where you really need the humans involved.
Exactly.
Another question that we had gotten in before the session was, you were talking about how you've got the different silos and sort of like the different approaches that people have. Well, I mean, one of your responsibilities is to make sure that, as we're talking about, the key people, the CEO, the board, is properly informed. How do you sort of balance those different views and different approaches? And also, how do you, and in particular, getting back to this notion of using data and using technology, there's some things that are very much amenable to data analysis. And there's some things that might be quite important where you don't really have that much data. So also, how do you kind of make that trade-off and make sure that you're not just looking under the lamppost where the light is for the keys?
Yeah, so in terms of the two good questions and quite different. The first piece to me is, candidly, most of it is about fitting. So it's being able to figure out, as you have your colleagues on your executive committees, and obviously they have points of view that they want expressed in front of the CEO, and they have things they don't want expressed in front of the CEO, and sort of using the judgment of, yeah, does the CEO need to know this, or need to be informed of this in order to run the company better? Or is it something that can be, that this individual can sort of manage it for themselves? That's always been my view on this stuff. If it's not critical for the CEO to know, if it's not going to change the way that they operate, I don't need to be running into the CEO's office every time I see something that I don't think makes sense. Frankly, I'd rather work on it with the individual who can change it rather than the CEO push us to do it anyway. Same with the board. I mean, board messaging is always very important, and it's hard for boards. For those of you who sit on public company boards, you really engage with the company only a handful of times per year. So, trying to take boards into deep operational types of things, frankly, it's not worth it most of the time, unless there's a big opportunity or a big risk and challenge there to be talked about, because you're just going to confuse them most of the time. So, to me, as CFO, CEOs don't like to give negative news to their board, right? They've got bosses, it's 12 or 13 bosses, so it's hard enough as it is, and giving them negative news is not something CEOs relish. Again, I go back and forth between, if it's something that's important for the board to know, either from a fiduciary perspective or from some other type of governance perspective, then they have to be told. But if it's sort of something that we're working on that we may be having challenges with, unless the board really wants to weigh in and help with the issue because one member or two have a particular expertise, I think more often than not, it's better off keeping the conversation with the board at a higher level, such that you don't wind up creating, frankly, lots of noise and consternation that's not going to help anyone anyway.
I think it's a very important curation function of figuring out what is important, what do people need to know, and then sort of curating to make sure that the things are in place. You mentioned Microsoft a few times, and you're on the Microsoft board. Of course, Satya Nadella is one of our graduates. What do you think is the key difference between the way Microsoft operates at that level, so the kind of the board interaction Microsoft versus the board interaction at PepsiCo?
Yeah, it's a great question. Microsoft, as big as PepsiCo is, Microsoft is just a massive company. I mean, our revenues are about $70 billion. Microsoft is more than twice as large. Obviously, a fabulous business, and it's really a fabulous set of businesses. It ranges anywhere from gaming to cloud services to obviously office productivity to a whole variety of other things. Um, One of the big differences I've observed, because both boards are good boards, and they kind of they get their job right. The job of a board basically is, number one, pick a good CEO, and if you do that, the rest of it gets a whole lot easier. Number two, try to engage in the strategy in a way that a good business person can, in terms of asking good questions and trying to understand the interconnects and trying to understand where you don't sort of see the connection that management does. That to me is an obligation of the board. And then after that, obviously, there's a whole lot of governance things that have to be done. Both companies do that very, very well. Probably the one difference is, because PepsiCo is a consumer product or a set of consumer products, and everyone can relate to them. There's a tendency on PepsiCo's board to sort of have points of view on product that, they're good points of view, but they represent the point of view of one or maybe a handful of people. And one of the things you figure out pretty quickly when you're in consumer products is your view, no matter who you are, is generally speaking relatively small in terms of the subset of consumers that are out there. So you have to constantly sort of push people back to, yes, but our research is telling us this, and this is what we've learned using data over time. Microsoft, because of the technical nature of the products, much harder to understand. The one that people tend to weigh in on more than anything is gaming, because people have kids and everybody sort of sees himself as something of a gaming expert. But weighing in on cloud architecture or weighing in on sort of legacy application challenges, it's difficult to do, frankly. So it takes you a good 2-3 years to really figure out how the Microsoft product portfolio even works together.
Interesting. That's very, very interesting, because that's a very interesting set of issues that you get to span, of being on the Microsoft board and being at the core of people saying, I don't like that chili flavor, I don't like that color. Very, very different kind of thing. We're almost at the end of our time, and what I wanted to do is, and so I thank the members of the forum for sending in great questions both beforehand and during the discussion. But since it is the booth CFO Forum, one of the things I wanted to ask you is, how do you see your booth training having affected your career or affected the organization? What are an insight that you think, or an approach that you took that you think is different because of being boothy rather than coming from somewhere else?
Yeah, it's a great question. It's funny, you all may remember Jim Lurie's quote. I remember when I was in school back at Booth, or at the time, the Chicago School of Business, I believe it was, but about, look, the odds of us being training you on exactly something that's going to be applicable exactly in your career 20 years later is incredibly low. What we try to do is teach a way of thinking, and that way of thinking will basically make you a better business person over time. I remember as a student, it made sense to me, and now as a senior executive, it makes even more sense to me. One good example of that is I took the commodities class and options classes and all of those things at Chicago when I was there. And probably about 15 years ago, I started to really get engaged in our procurement function. And we had this notion that the guys were all convinced of, that value zone was sort of their mentality. And essentially it's buying on the dips, right? Was sort of the strategy. And we were at the time in a 10-year commodity deflationary environment. And as a result of that, there was lots of value zones and lots of dips. All of a sudden, commodities sort of turned from deflationary to inflationary. And I never thought the approach made sense, right? If markets are truly efficient, this notion of buying on the dips isn't really going to work. And I think there's been a lot of studies that have proven that out over time. So I questioned their strategy, and I finally said to them, look, okay, my view is our job is to give the business predictable costs so that they can take pricing with their customers. That's the business that we're in. We're not in the business of being the low-cost commodity procurer. And I said, look, we're going to buy ahead 3, 6, or 9 months, but I'll tell you what, I'm going to allow you to sort of reverse engineer this. You pick 3, 6, or 9 months and show me any sustained period of time where your strategy is actually beating what I'm describing. They couldn't do it. I mean, they went back 5, 7 years. They tried going back 9. They still couldn't do it. And to me, that Chicago training around efficiency of markets, that Chicago training around sort of the biases of internal organizations versus the way markets operate, frankly, it just led me to the conclusion that, no, I know this strategy is going to be right. I use data to sort of prove the point, but it was a phenomenal example of, hey, what you learned at Booth, principles, actually made me a much, much better CFO. And we've been running that procurement strategy now for the better part of a decade, and it's worked out fabulously well for us.
That's great. Yeah, turning PepsiCo into a hedge fund is not clearly the best,
No one
best thing
wants
to
that.
try to do. I don't think for any of the employees, or certainly for the shareholders. Well, this has really been wonderful. Thank you so much for being so generous with your time and with your insights, telling us about the challenges of the pandemic, but how to work through that. About thinking about the role of the CFO going forward, and the role of efficient markets, taking that from kind of a Nobel Prize winning theoretical idea into practice. So
Absolutely.
we're now going to take, so please, everyone should applaud or send their little hands, the hand applause up. That would be great. And now we're going to take a 15-minute break, and then I'm really thrilled that Steve Kaplan is going to come in and generate some really interesting discussions about, I think, one of the most challenging issues that corporations and CFOs face right now are the purpose of the company, the objectives of the company, and Steve's going to take us through that. So see you in about 13 minutes. We'll start right on time. Thanks.
Okay, terrific. It looks like everyone has returned. So I hope you enjoyed that. Got to meet some people you knew, got to meet some people who you didn't know. Now let's ask a few questions. So the first one, do you agree with Friedman? Okay, get your votes in. Almost everybody's voted. A couple more seconds. Okay, let me show you what is there. This is very interesting. So this is a very Friedman-friendly group, which you might not get if you read the New York Times, that there's so much support for this, or even the Wall Street Journal. Very interesting. Does someone send Jason think it's a Booth Forum? It's not shocking. Maybe Kellogg would be different. I don't know. That's a good question. We should check on that. Although I'm not, that's interesting. I'd have to think about that Kellogg or HBS, but it's not unanimous. There's clearly decent number of people who are on all sides. So with someone who agrees, want to articulate that, and you can use the raise hand function. That way we know if anyone wants to talk, and that's in the reaction thing. Does anyone want to say why they agree or articulate that? Not a chatty bunch. No one's falling.
I don't see the hand raising, actually,
Yeah, I don't either.
Dr. Kaplan.
Oh, go into reactions and then click raise hand.
Yeah, it's not there. We can clap our hands.
It's not there?
Oh.
You can go more and you can see it.
More.
Is it under more?
under more.
I don't even
Yeah,
see.
there is a option called raise hand under more. Yes.
Okay, good, good. Very good problem solving. Okay, Jason, there you go.
Good morning, everyone. So our group did choose Friedman over Fink in large part, given the staying power of the model, especially around the measurement criteria, being crystal clear around shareholder returns. It's not that there isn't merit in the Fink model, but our struggle was that the scorecard is not as clear, and we debated the fluidity and fragmentation around ESG and standards. What's the scorecard? And that seems to be the biggest shortcoming of the Fink model, at least now.
Very interesting. Although, we'll see whether that can be improved over time, the scorecard. Someone who disagreed, or Ryan, go ahead, Ryan.
Actually, I agreed, but for completely different reasons. I actually think Fink is being consistent with Friedman, but focused on a different time horizon on the definition of shareholder value, and focused on this idea of open competition and less deception. So the question is, what sort of information needs to be out there for shareholders to make informed decisions?
So you would want more information, as long as he's a believer in a lot of information out there, and you're saying you want that?
I think it's fair for investors to look at certain time horizons. I think the Fink investors are more of a long-term investor than a short-term investor. So I think they believe there's certain actions that can be taken that can be consistent with both driving profits long-term and sustain. I think they're trying to equate.
Okay, they're consistent. Okay, that's fair. Anyone who disagrees? There were 8 of you. Anyone want to articulate that? Or uncertain? I'll take disagree or uncertain.
I on uncertain, I would say when Milton Friedman wrote this, I think it was 50 years back. There's a lot of relevance to that even today, but companies would still have to maximize profits and let the shareholders or the stakeholders of the company make their personal decisions without having using company's resources. However, there's no isolation, and these decisions should be made collectively. So that I was uncertain in some aspects. I would say yes, companies should have this corporate social responsibility, and on the other hand, should the few management or the few senior executives of a company make their personal choices and make these decisions and put money in some of these corporate social responsibility or causes where they feel. So that's where I was in between and uncertain.
Okay, interesting. Chet?
Yeah, thanks. So, I'm CFO of Clear Result, and we're a mission-driven company that offers a comprehensive set of energy programs that aimed at energy efficiency and demand-side management. And we're owned by TPG's Growth and Rise Fund. So the Rise Fund is their impact investment vehicle that's really committed to achieving measurable social and environmental impact. And they're the LPs there is a large interest by LPs in profitable social impact. So for us, it's both. And I think maybe there's a question of investor sentiment, right? It depends on your shareholder or your investor base as to whether or not you're directed to do so.
Now, do you feel that you compromise returns for doing that, or are you trying to get high returns as well as having the positive social impact?
It's both. Yeah,
it's both. So you think it's they're complementary or synergistic?
Yeah, but given the space that we're focused in, where we're really focused on energy efficiency, it's a natural outcome of our mission.
Okay, very interesting. Well, let me ask a second question, which is related to the energy and climate. So here's question number 2. How big a risk do you think climate is for your company? Okay, anyone else want to vote? Okay, let's take a look. And interesting. So this is a third of you were small, almost a half moderate, and some of you large. I'm actually curious about the large people. Does anybody large want to explain why it's large and how that works? Nobody.
And maybe Steve, it's Ray Young here. Let me jump in here. And so we're ADM, so we're one of the largest food companies in the world. And so we have a responsibility of feeding the world, frankly speaking. And so our biggest concern with climate change is as more areas become arid. Like you think about China, right? The crop growing regions of China, the desert is now infringing upon Beijing right now, as an example, right? So we get concerned about like how, we look out 30 years, 40 years from now, how are we going to feed the world, right? If the climate continues to evolve. And so we're thinking through these issues. It actually forces us to become even more adept in terms of shifting food from areas of surplus to areas of deficit. But we're thinking beyond this, right? We're thinking about how can we be even more efficient in terms of creating food. And so, we're into plant-based proteins, we're into cell-based proteins, we're into microbial-based proteins. I can assure you, 30 years from now, you're going to be eating different types of foods, right? You're going to be eating different types of food than what we're eating today, right? And so therefore, I always say that climate change, the environment, it's core to our existence and also core to the opportunities that our company will be involved in. Because I'm pretty sure 30 years from now, our company is going to be a very different company than it is today. So we're evolving to reflect this, and climate change clearly has a role in terms of influencing our strategy.
That is very cool. So it's a real, you see it in real time. Very interesting. Okay, now I'm gonna broaden this one, and I want to broaden this one. Then this will be relevant too. So next question, which is really we've touched on, but let's talk a little bit more. Now, we've got Larry Fink. So we had Friedman, and people were pretty supportive. But Fink is might be different, might be the same. So do you agree with Larry Fink that sustainable climate integrated positions and purpose provide higher returns? Okay, get your votes in. I've only got, okay. Now this is so interesting. Okay, now let's go. So look at that. Look at that. Collectively, we have no idea. I love that. So this is one where, wow, I would say this actually means that, from Randy and my perspective, this is clearly, a place where research is necessary, since we have no idea. But might be a good idea. This is good. We've got 5 minutes left, so that'll be what we need. Someone want to take the yes, the no, and the unsure? Take any of those positions. I'd love to see if any of you have a strong view on this. Patrick.
Well, do you think it's possible that he's trying to pull everybody into increased disclosure and debate, just to help? My suspicion is he knows it's relevant, and he's trying to pull everybody into the debate so he's not having to opine on his own. and resolve this himself for his shareholders, that he has people in the boat with him. Maybe I'm giving him more credit than credit is due for being altruistic, but I think that's his objective.
To getting, and so does that make you unsure, or where are you on this?
I voted uncertain just because I think the reality is it's hard for people today to know some of these social costs and to fig them into a return equation. And so I think he just figures the sooner we start putting cards on the table and looking at them together, the sooner we could figure it out together.
Interesting.
Yeah, I think I couldn't find the more thing, so I'm just going to jump in. I think the context that's missing from the question is what space you play in, right? If you play in the food space or something involving hydrocarbons, et cetera, there's much more of a direct link to your business. Whereas if you are leading a large public accounting firm, right, the activities that you participate in that could impact your returns in that space may or may not directly impact the value that you create or destruct. And so I think that's the context that's really missing. And also the concept of what's the time horizon you're looking at. I put unsure for both of those, because if you're talking about for the next couple of years, maybe a little bit less of a risk. But if you're looking at 20, 30, 40 years, if current trends persist, then maybe it does become a little bit more elevated.
Interesting.
I'm going to jump in because I'm also Zoom challenged. I can't find the more button.
Okay, and then I'm going to go to Steve and then Jay. Go ahead, Chris.
Thanks. Just to be quick, I'm unsure because I hear about higher returns with the focus on ESG, but I've never seen anything of substance that says it's correlation or causation. So of course, if you're doing financially better, you have the resources and you can allocate more capital towards ESG, makes your employees feel good, and there's some compounding. So I'd love to hear it if anybody out there has seen good, valid study that there is real alpha associated with investing more on its own versus being correlated with a richer firm being able to do more.
Well said, Chris. I agree completely. Yeah.
Okay, Steve?
Yeah, I said yes, because in my experience, just taking on safety or environmental challenges spurs creativity in the organization and has allowed us to get to better solutions. And ultimately, the people who solve these problems will run better businesses and create more value. So it's a success factor, I think. If you achieve what Fink is suggesting, that you solve those problems, you will create more value.
Interesting. Jay?
So what I was going to say, just jumping in as well, is I think it is a matter of applying the same discipline to these sorts of challenges as you would do other types of investment decisions. And so do you have the information to understand what are in effect the positive NPV projects in this space? And maybe for some it's easier than others, as Jeremy said, food and energy and such, but others, how much of it is more of an employee engagement issue, which is also a good use of resources, but where are you on the continuum? I think you can overinvest depending on what your starting point is and kind of the elasticity of the return opportunity.
Jay?
It's always hard to look forward and know exactly what's going to happen. And I think what Hugh talked about earlier, look backwards, right? Pick a point in time and roll from there. When he was talking about commodity prices and when it was time to buy or not to buy. So go back and look at a paper mill, God forbid. The one that built a coal-fired boiler as opposed to a gas-powered cogeneration, right? So I think what winds up happening is whether or not it's crystal clear in today's view from an NPV standpoint. I think as you look forward to regulation and what will wind up changing, society is going to force change, whether we like it or agree with it today or not. And so I think investing in that direction will generally create more value.
Interesting.
I'm going to jump in as well. It's Karen. Hi, how are you? We have this debate on our pension advisory committee all the time because as fiduciaries, we're actually held to regulatory standards that say we can only have an offering of an ESG fund if it is equivalent essentially to the relevant equity index. And so we have this debate all the time. And it is very, very hard to actually prove out on a market data basis that these funds are in fact generating exceptional returns. But I would really love to see University of Chicago jump into this.
Excellent. Well, that is a great way to end because I think we're out of time. I think we probably could have gone, Randy, you should have given us like an extra 45 minutes. What did we do here?
Everybody wants 45 minutes. You have to be constrained. You said, you close the meetings early. I agree.
So, I mean, it looks like actually what's kind of interesting is you're definitely as a group, value maximizing motivated, which is great. And at least from my perspective, since I like what Milton Friedman had to say, but I think what is unclear, and I think, over time we'll learn more, is what are the levers to push that actually get you that value. And I think I agree. There'll be many companies where it really makes sense to do what Larry Fink says, and it's very correlated with increased value. But there'll be some where it's not, or where it may have some cost. And I think over time there'll be interest or be a lot of attention paid to figuring that out. And I think that is right. As Karen, it's a good thing for us to do research on. And I'm trying. I've got one project that I'm trying to do. So maybe next year I'll tell you about it if I can get the data. So with that, thank you so much. It was great to see you all, and I will hand it back to Randy.
Great. Thank you very much, Steve. That was super, super great. And yes, we always want more time, but hopefully this will spur conversations that will continue beyond the forum. Just one point on the poll, that first poll that you did. I asked almost exactly the same question when I did that Corporate Social Responsibility Revisited conference last September on the 50th anniversary of Milton Friedman's famous essay. And so it was open to the broad public, but we disproportionately had Booth graduates who were in the audience. And I did the same a poll in Hong Kong, a poll in London, and a poll in Chicago. And what was interesting is that we got almost exactly the same responses globally. I wasn't expecting that. And the response was very different than what you guys put forward. It was 2/3 against Friedman, 1/3 in favor. And it was sort of 60-30 and then 10% uncertain. So very few people uncertain, but it was very interesting to see that it was very different, even in a broader Booth audience, that you had that. So lots of different views around the world. So we're going to take now a break of 12 minutes, and we'll start right on time to see how the nonprofit sector has been affected, and also the complexities of dealing with a nonprofit, which I think many people don't realize are just as great, if not greater, than a for-profit institution. And Stacey Frank is going to be very interesting to talk about that, because she made the transition from being at Exelon for, I think, about 14 years to the CSO 3 or 4 years ago. And the CSO has actually made it through the pandemic reasonably well. Actually, what we can do is, Morgan, if you might be able to send out there was an article in Crane Chicago Business about how the CSO has dealt with this, even though there's been no revenue basically that has come in for the last year. Stacey will give you some insights into that. So I'll see you in 11 minutes. Thanks. All right, so welcome back to the Booth CFO Forum online. I thought it was a really interesting and great session. Hopefully you enjoyed that, of being able to connect with your colleagues and discuss an issue that, of course, is one that is core to University of Chicago. I mean, Milton Friedman really launched the focus on that issue 50 years ago. And I think in great University of Chicago and Booth fashion, we are still debating the way Friedman put it. And I think that's extraordinarily important. I mean, that's one of the things that I love about Chicago Booth, is that we may, we we do a lot of different pieces of research, some of which are short term, some of which are long term, but a lot of it has legs. And obviously, we're still debating what Friedman said 50 years later. I think that's a real hallmark of how we approach things. Kind of get at the fundamentals, get at the framework, and it lasts through the decades. Now, what I'd like to do is, as I mentioned, turn to a fireside chat with Stacy Frank, who, as I said, I'm very proud to say is a student of mine. Took my money in banking class a number of years ago, and Stacy is a really interesting person to talk to about these issues, because she spent 14 years at Exelon. So she's been in the private sector, and then she made the transition to go to the CSO in 2017. And actually, we've seen a dramatic transformation at the CSO. It's not just me, but I had a lot of my colleagues on the board of trustees said, "Wow, things are really so much clearer now with Stacy as the CFO." And I think that is a tribute to Stacy and a tribute to the kind of approaches we take at Chicago Booth. And maybe that's where I want to begin, Stacy. We might talk a little bit about the transition from the private sector to, or I should say, both from the private sector, from the profit sector to the nonprofit sector. How did you make that transition? What's similar and different in publicly traded institutions versus a nonprofit like the CSO, which is a very large and complex organization?
Yep. Thanks, Randy, and happy to be with you all. Yeah, when I made the transition about 4 years ago now, I was expecting it to be probably a little bit more of a contrast. And what I've learned, and learned pretty quickly upon joining the CSO, is it's more similar to working in for-profit than I would have ever expected. This whole concept that kind of permeates the not-for-profit sector is this phrase of no money, no mission, right? And when you think about that, coming from the for-profit sector, it's very much the same, right? It's about making decisions that execute on the mission of the organization, regardless of what it is. And for us as CFOs, trying to do that in the most financially efficient way that we can. For us, it has a little bit of a different bent on it, maybe from the perspective of we're not doing investor relations, we're not talking to the street, but we still have to be good stewards of capital for our donors. Contributed revenue makes up about half of our total revenue each year. So if we're not good stewards of that capital, our donations are going to dry up, and we're not going to have a mission or the financial wherewithal to continue to support that mission. Much like all of you that work in for-profit businesses, public or otherwise, you're talking to your investors all the time and convincing them that you're good stewards of capital in your own business. As you mentioned, Randy, we're a really complex business. I think that's one of the other things that maybe is not well known about not-for-profits in general and the CSO more specifically. I mean, we're an organization that encompasses unionized and non-unionized groups. So I'm dealing with collective bargaining for major components of our business, right? Our orchestra is unionized. Our Chicago Symphony Chorus is unionized. So having that piece of the puzzle is really critical. We own and operate a large facility. So we're real estate operators as well. And we're a large employer within the city of Chicago, not along the lines of the big banks or other major corporations, but we do employ about 600 people at the CSO. And so, for us, it's running a business, and it's a complex business that has a lot of product lines. It's a complex business that has debt. and we've got to deal with that, the complexities that come from that. And we've got $500 million under investment through our endowment, through our pension funds, and our other unrestricted funds. So we're dealing with asset allocation and all of that from an investment committee perspective, which I know, Randy, you know well as a member of our investment committee.
Yes, no, that was great. I actually want to pick up on two things that that you mentioned. Well, actually, there's something I think a very thoughtful intervention in the chat from Ileana, that not-for-profit does not mean no profit. It's just an organizational and tax designation, but it's still a business. And I see that very much at the CSO. Retained earnings are designated to be reinvested in the organization to accomplish its mission and objectives. And as Stacy said, if we're not doing a good job, the trustees are not going to support the organization. People are not going to show up and now, of course, people can't quite show up at the moment, but it's there is very important objectives that have to be reached. But I wanted to touch on two of the things that you mentioned: pensions and unions. And so one of the challenges that we had was we had a strike. Now, I think many people don't realize that the members of the orchestra are unionized. The members of the chorus are unionized. Actually, the CSO is quite unusual in having a professional chorus. Very few organizations, or at least major organizations in the U.S., have one. And so, but one of the challenges we faced was the pension and trying to deal with the pension. And maybe Stacy, talk a little bit about that, about how you made the board aware of the issues and how that worked out. And we actually had to strike over these issues.
Yep. Yeah. I mean, upon arriving at the CSO in 2017, one of the first things that kind of was top of my priority list is how do we get control of the large defined benefit obligations that existed in the orchestra pension plan. Certainly not new news to anyone, but it was a topic that really the best way I could describe it is we had kicked the can down the road and we were coming to the end of the time where we could continue to kick the can down the road. Dealing with a unionized group where our collective bargaining agreements run for typically 3 to 4 years, you don't get many bites at the apple to address this challenge. And there had been, prior to my arrival, a number of times where this had been brought up in the negotiations of a new collective bargaining agreement. And because we knew it was going to be a very challenging issue and one that was likely going to cause a strike, we tabled the issue. So one of the things that I did coming in new to the role was really try to, as a good Booth alum would do, use data as my guide, and really kind of work very closely with our actuaries to try to drive a business case for why it was so critical to address the problem and why the longer that we waited to address the problem could really kind of expand the possible outcomes, which could be very, very disastrous for the organization, quite frankly. So a lot of it was around pulling data together and then figuring out a way to present it effectively to the board, to show them why it should matter to them now. What are the range of outcomes that we could be dealing with, and putting it in a very simple sources and uses of funds perspective. So low discount rates over time, decent returns, but not great returns in our pension trust due to the asset allocation, and the variability of potential outcomes in our funding obligations were the critical factors that we had to clearly get across first to our board before we even decided to take it as a negotiating point to the union as part of the negotiations.
No, and I can attest that this was really transformative because the CSO had known this for a very long time, that these pension obligations were not on a sustainable footing and something had to be done, but no one ever wanted to really deal with it directly. And I think this really, and what Stacy did was something that is very much consistent with what Hugh Johnston had spoken about. What does the board need to know? And so I know how much work Stacy and her colleagues did to figure out, what were the challenges, what were the issues. But exactly as she said, she put it in a way that made it really stark and say, we can't wait any longer. We've been talking about this for years, and this is really potentially problematic for the survival of the organization that you love so much and that you've given so many resources to. And so she was able to convince the board, this is not an easy thing to do, to convince a board that it's worthwhile to put up with a strike, especially with, this is a nonprofit board where people are, they want to enjoy being on the board. They love the musicians, and they don't want to get into a difficult situation with them. But we had a fiduciary duty, we felt, to do this because we really cared about the musicians in the long run, and then worked through that and prevailed. And Stacy and her colleagues were crucial in that. And I think that's a very interesting parallel with the for-profit sector, because of course there are a lot of union negotiations that are going on. So now let's turn to how the CSO has dealt with these challenges. And so we circulated an article around from Crane Chicago Business with a great title. How can the CSO be shrinking its deficit and still paying its employees and its musicians when it hasn't been doing any performances for a year and a half?
Yep. Yeah. I mean, I think the challenges for us are very similar to the challenges that any business faces. I mean, we've had to adjust and be flexible and pivot. But when you think about our business is putting 2,500 people in Orchestra Hall, elbow to elbow, 4 to 6 nights a week. So obviously over the course of the last year, that has been very challenging. We have not had any live performances. Actually, a year to the day today, we were sitting in a conference room when the governor of Illinois basically implemented a stay-at-home order, and we had to cancel 30 days worth of concerts was the decision at that point in time, and we all know where we've been since. But Randy, you're right. Our annual operating revenues, as I said, make up about 45% or so of our total revenue. And that has gone to zero. So it puts significant pressure on the ability to fundraise and the ability to adjust the cost structure very quickly. When the pandemic started, we were already 9 months into our fiscal year. Our fiscal year ends on June 30th. So the ability to kind of completely change the cost structure was condensed into even more short of a period of time because we had June 30th debt covenants that we needed to meet on what our operating deficit was going to be. So there was a lot of quick pivoting that we needed to do that was specific to our circumstances in a lot of ways, but also very similar in the decisions that I'm sure everyone on this call had to make in the face of the pandemic last year.
And then I have a question coming in from Ray about going forward in the post-pandemic world. Because how are things going to change? What's the future of live performance? Because this is, we know that, or at least from my point of view, I think there are a lot of areas of the economy in hospitality and transportation and entertainment, like the CSO is part of that, which is just not going to come back the same way that it was before, or it's going to be a very, very long time before it does. And so how are we going to change the business model? Because basically the CSO, just celebrated, I guess, about 130 years. And basically been doing the same thing for 130 years. Live performances, people coming, listening to music, loving live performance, but we can't assume that's going to be the future.
Yeah. And I think there is a thirst for people to get back out and enjoy culture and enjoy the arts. And so the hope is that we do see people come back to Orchestra Hall when we reopen our doors this fall. But you're absolutely right. To assume that we're going to have 2,500 people packing into Orchestra Hall every night is not an appropriate assumption for us to make at this point in time. So we're doing, I think, a few things to try to respond to that. One is a digital platform that we invested in and released in the midst of the pandemic called CSO TV, where we're filming small groups of musicians on stage in Orchestra Hall, highly produced. So this isn't, the tiled Zoom, people doing this in their living room. And trying to stitch it together kind of production. It's basically a formal concert experience, but nothing can really replace the in-person nature. But we're trying to figure out where that will have a place in our set of products going forward. We're working with Ravinia and with the city of Chicago on outdoor venues and how can we make more use of outdoor space, at least through the summer months and into the early fall. But it's absolutely a good question. I mean, one of the things that we've been challenged with over several years is that there are so many entertainment options available, right? In our Netflix culture, in our digital culture, how do we continue to get people to come out and watch live music? And so we've done a lot of audience development, even pre-pandemic, and a lot of, patron surveys and data collection to try to identify what changes do we need to make in order to respond to changing tastes and the changing nature of entertainment in the world that we're living in.
Yeah, I think this was a challenge even before, exactly as Stacey had said, it was a challenge before the pandemic. And as with many things that associated with the pandemic, it sort of accelerated these trends, because people are now often watching YouTube to get old performances of music, and that they might not have done before. And they think, well, do I really need to come to downtown Chicago? Do I need to come out? Are there risks associated with that? And this is the same for many of you in in your organizations. The consumer is going to be acting quite differently than the consumer did before, and trying to transform that and use some of the tools that we've been using now to try to promote that. So where do you think the greatest opportunity is for the CSO, as well as other organizations like that, to be able to use the technology to survive, to both pursue its mission of promoting music, and also make sure that the revenues come in to be able to support that mission?
Yeah, I mean, our digital platform, I think, has been a really great investment for us, from the perspective that although we're making some revenue from the individual streams because people are paying to watch these performances that sit behind a paywall. The difference for us as a not-for-profit on something like that is what we're not making in terms of earned revenue. We're staying in front of our donor base by having a platform like this that keeps us connected to our donors instead of just going dark, right? So that was a really, that was a decision that we made very clearly when we were deciding whether we were going to invest in this platform. we wanted to figure out a way that we would not fade into the background, right? We needed to stay front and center with the people that mattered to us most, our donors, our patrons. And without live performance to do that, we had to quickly pivot and figure out how were we going to do that. So what that holds in the overall product mix for the CSO going forward remains to be seen. I mean, it will continue to be an important part of what we do, but we're really hoping to shift back to live performance, do it in a safe way. That may mean, you know, we're thinking about things within the hall around, you know, do we need to build a stage extension? How does that impact sight lines? Where will we have places in Orchestra Hall where if we change the way the stage setup looks, we're going to have obstructed view seats? And from a marketing perspective, what does that mean from a pricing model? So we're trying to go through all of the ways of not just adding to the mix by adding this digital platform, but rethinking all of the product lines that we offer and what makes the most sense in light of a post-pandemic world, knowing what we know. And I think one of the key things for us, which I'm sure is not unique to us, is this increased need to be very flexible. I would say pre-pandemic, I would not have described the CSO as a particularly flexible organization. And so I think it's one of the silver linings coming out of this that we've learned as an organization, as a senior leadership team, and as a board, how we're going to need to be flexible and willing to adjust on the fly to things that have been thrown at us that we may not have expected.
You know, and Jeremy in the chat makes a very good point about you know, obviously this is not unique to the CSO, but seeing that there are opportunities in these new technologies, and we're going to have, you know, like it or not, we're going to have to embrace them. Margaret has a question on about the whether the digital platform is able to expand both the donors and the patrons, because you talked about how that's helping with the with our traditional people. Can it reach out to Chicago residents in other states or younger generations? And this is actually a very interesting issue that's being debated more broadly on the internet. There are these transformations that are going on with the development of something like Clubhouse, which is a platform for basically for an alternative to podcasts that bring them all together in one spot. And it would be eventually probably a subscription service. This has also happened with another thing on the internet called Substack, where a lot of individual writers who've been working either on their own or doing a blog or working at the Atlantic or the New York Times are now going to this technology, or this platform Substack, and then having subscriptions and being able to have an incredible audience because the internet reaches people around the world. So could this you know, allow us to dramatically increase our base?
Yeah, and it already has. One of the things when we launched our CSO TV platform was we wanted to have a lot of data analytics that sat behind it. So myself and our VP of marketing are really kind of data nerds. So we built a number of dashboards within our CRM system to really try to pinpoint where people were engaging with us on this platform. And we literally, I think we're up to 49 states. So if anybody knows anyone in South Dakota that wants to watch TV, I think we'll hit all 50 in 24 countries. So we are expanding our reach significantly. We've always had people travel to watch our live performances, but when you can do it from literally almost anywhere in the world, and engage with us, not only does it help from that digital platform itself, but it's creating a connection with someone that we can use to target them for, you know, particular advertising campaigns, particular donor stewardship campaigns, both now in the midst of the pandemic and also going forward? How do we keep them as part of the family and bring them along the journey with us as we come out of this and hopefully move forward? But yeah, it really has allowed us to expand our reach.
You can really build on, I mean, fortunately, the CSO does have a global reputation. It's not just something that is in Chicago or in the US. I've been fortunate to be able to see performances both in Tokyo and Paris of the CSO and see completely sold out performances. So, figuring out a way to be able to continue to connect to those audiences, even though it may not physically be there, you've got a brand that can work that way. And I think thinking that way, for many of our institutions, not just for the CSO, but for others, about how you can reach new audiences and using this and get revenues from this is super, super valuable. So I'm going to ask the question that I always like to ask, and I'd asked you. So what is it, do you think, in your Chicago booth training that has allowed you to make the kind of transformations that you've wanted to make, and how has that been important in your career?
Yeah, I think about my role within the CSO. Among the leadership team, I am the only person that does not come from a musical background. So whether it's people in our development department or marketing or artistic programming, everyone's got a musical background. I played the piano until I was about 10 years old, and that's about the extent of my musical training. But I take that into my role and really use it to question the status quo. I think for a mission-driven, not-for-profit, it can be easy to get so caught up in the art form itself that we allow ourselves to just do things the way they've always been done. And so I've really been the nudge, I think, hopefully in a good way, to really question the status quo and use data to show people what's working and not working. And I think a lot of that, almost all of it, comes from my booth training. So I feel like I'm using what I learned at booth literally every day.
That's really great. Good. Well, Stacy, thank you so much. That was really informative and valuable. Well, actually, maybe just we have just 1 minute, because I'm on the board of the CSO and some other arts organizations, and you're on the board of the Children's Museum in Chicago, as well as working at the CSO. I think that's a very important part of being a CFO and being a leader in your organization and the community. Do you have any thoughts on how to get people to get onto boards, how to think about encouraging them to get onto boards, what it means to be on a board, how to be an effective board member?
Yeah, I mean, I think the number one thing is to get involved in a board where you have a passion for the mission of the organization. I think what I find with the CSO board that I interact with pretty frequently is the board members that I gain the most input and insight from are people that really have a passion for our mission. There's varied levels of involvement. We've got a very large board, 60 board members, 130 if you count all of our life trustees. So it's impossible to really kind of know everyone at the same level. But the people that I know and that I engage with are people that really have not only a passion for what we do as an organization, but want to see it done in a financially sustainable way. And so that's where I think CFOs in particular, if you're thinking about your board involvement outside of your day jobs, pick something that is of interest to you, and pick something where you can have a voice in helping the organization to thrive. Because I really do, from my seat at the CFO level at the CSO, really depend on insights that I can take from several of our key board members and from what they're doing in their day jobs. And it really helps me perform at a good level within my own role. So those are just a couple of tips. But yeah, I think the biggest thing for me is it takes time, and time is something we're all short on. So you have to do it for something that you really love.
Great. I think that's really great way to end. Thank you so much, Stacy. Thank you for everything you've done, the CFO, and also thank you for your thoughts and I think really great insights into the parallels between the for-profit and non-for-profit world that I think many people don't fully understand. And I encourage people to get onto these boards, even if you don't think you can move the needle in terms of the donations. Sitting on the investment committee, if you can get rid of some not so good investment approaches and get the returns up even 10 or 20 basis points on a few $100 million, that's a big contribution. So thank you so much. And now I think Madhav has joined.
Hey, Randy.
Excellent. Welcome. And I'm sure all of you know Madhav Rajan, our dean at the Booth School of Business. And we had a lot of questions that came in from both our advisory board as well as others in the CFO Forum about, well, what's the future of the MBA? What's the future of education given the pandemic and given some of the trends that were happening beforehand? And there's an infamous, I think, Wall Street Journal article that basically says, is the MBA dead? And my hunch is that Madhav and I kind of not so sure about that. I don't think we'd be in this business. We think it's a little bit of Mark Twain. It's maybe a bit premature to have written the obituary on the MBA. But Madhav, I'd love to get your thoughts on broadly the trends that were in place even before the pandemic, but particularly the challenges of the pandemic, and how can we pivot to become stronger going forward?
Right. Thanks, Randy, and thanks, everyone. It's great to be able to speak to all of you. I think as Randy put it, I think the stories of our demise were greatly exaggerated. You all know that whenever there's a story like that, oh my God, is the MBA dead? You should probably, short that and go the other way. In many ways, that was actually the turning point. This was back, I think, 2+ years ago. And that year we were I think we were the only top school to actually have an increase in applications, but that was sort of a leading indicator. Last year, I think like 3/4 of all MBA programs saw increases in applications, and some of them saw big increases. I think something like 40% reported quote significant increases. And that's continuing. So we set a new all-time record for us in terms of applications last year. We will beat that record again this year. So certainly in terms of whether there is market demand for what we have to offer, I think there is no question that continues to exist. The MBA, I think, remains the best program for somebody who's sort of 2 to 6 years out from their undergrad, who are thinking about, okay, how do I retool myself? How do I think about a pivot in my life, in my career? How do I even find out about all the other things that I could be doing? Many people do their undergrad, sort of take a job, and then are in like a particular field, but they haven't really had the chance to even think about what else could be there, right? What else would I be good at? They've learned something about themselves. And I think the MBA remains the best program for all of them to come in, acquire new skills, acquire information about what's out there, and do that pivot. So I think that continues to remain super strong for us. I use the word 2 years. I don't use that lightly. I think one of the issues that happened over the past 15, 20 years is that the age at which people come into the full-time program has sort of been creeping up. So we were at a point where it was something like 5+ years out of undergrad that people were looking to come back. And we have very deliberately tried to reverse that by bringing in students who are out maybe just even 1 or 2 years out of the MBA, provided they have significant experience. And that's helpful for a couple of reasons. Often we'll have undergrads who take a job, and then, after a while, it's sort of hard for them to even conceive the notion of going back to school, right? They've had, they have a family, maybe they have kids, they're sort of embedded in their jobs, and they're not sure sort of how to make it work. And I think sort of capturing that market again is something we've been pretty aggressive in doing. So one of the reasons we were the only school 2 years ago to see an increase is we put in what's now called these 2+2 programs, where you can have somebody apply as a college senior to an MBA program and get a deferred admission. So we don't take them in right away, but we tell them, okay, go work for 2 years, and then you have guaranteed admission to Booth sort of 2 years hence. And that's been a huge, boon for us in terms of attracting students from lots of different universities we might not have otherwise gotten them from, and students who might never even have considered doing an MBA, right? They now see, oh, that's a viable option. And they love the notion of a 2-year option that they can go do sort of a risky job with the backstop that 2 years from now, they can come to Booth and do their MBA. So that's sort of working well. I think the other reason that I have confidence in the future of the MBA is that at least at the top schools, we've been pretty aggressive in terms of changing the nature of the MBA. We're not offering the same product that we did, 10, 15, 20 years ago. If you look at the set of classes that we teach, it is very different now. Lots of new courses in, so for example, we have a whole social entrepreneurship area at Booth, which didn't even exist, sort of 15, 20 years ago. We have entrepreneurship, sort of regular for-profit entrepreneurship. And entrepreneurship, some of you may know, is now the #1 concentration at Booth. And with technology taking over the world, I mean, pretty much every industry is now a tech industry, is one way I think about it. That puts Booth at a significant advantage because we've always been the school of great empirical work, right? Rigor in terms of thinking about data, understanding data, how to use it, how to work with it. And that's sort of given us a huge advantage. So we've pivoted our curriculum. We've put in a new concentration called business analytics, which is proving to be very, very popular. So you'll all appreciate that we send more students now to tech than to banking, right? Which is sort of unthinkable from the time when you were students. And so for a lot of our students, the job they really want now is to be a product manager in a big tech company. And the Booth MBA is sort of perfectly suited for that, right? Particularly if you've done a relatively more technical undergrad. It doesn't have to be CS, but it could be, sort of, applied math, whatever, physics, something like that. And you pair that with an MBA, those are the perfect people to be product managers in the big tech companies. And, in the tech companies, the PMs are the ones who run the company. So that has been sort of a whole new pathway that we have discovered, if you will, for our students to get into. And so by sort of pivoting the MBA, we've added classes in machine learning. We've added courses in app development as part of the MBA program, in AI, digital marketing. And that's sort of attracted students who sort of get their dream jobs in tech as a result of that. A couple of other points I'll make, Randy, not to keep rambling on. One thing that, again, we have done is to make the MBA more experiential. Booth has always been a phenomenal disciplinary school, as you know, right? We have great economists, we have great people in finance, fields like that. But I think the nature of the MBA, we've sort of tried to shift it to give students more experiential options while they're in the program by adding what we call lab courses. So we have a private equity lab where you actually work in a PE firm while you're at Booth. We have a venture capital lab, which we launched just sort of a year and a half ago. We have leadership labs now, right? Places where you can actually practice being a leader. So we've tried to sort of add these other skills as well on top of the actual coursework that we do. And that's made the MBA, I think, more attractive and interesting. And the final thing I think that we have done well to keep the MBA going is to realize that the future is all about interdisciplinary work. So we have been encouraging our students to come into Booth and say, okay, you're doing an MBA at Booth, but here is a university which has an amazing law school, right? And so how would you sort of combine that? So we've launched these new joint degrees. We launched the new accelerated JD MBA just this past September, which is like a dream degree for all your kids, right? It's in 3 years, you get a Chicago Booth MBA and a JD from the University of Chicago Law School in 3 years. So the same time it would take you to get a JD, a regular JD. So as you might expect, this is proving to be wildly popular. So we have huge sort of interest in it. So I think that's again part of the future, Randy, is finding ways for us to augment what we teach at Booth with what's offered in other units on campus. Last point on the pandemic, as you know, one of the big things we have had to do with the pandemic is switch to more technology-based teaching, right? Sort of remote learning. And sort of one of the future for us is figuring out as we get to normal, and our expectation is we will be at normal this autumn, how do we augment what we teach at Booth using technology? Not as a substitute, but as a complement to sort of what we do. Okay, sorry.
I think that's extremely important. I mean, and you know, the joint degree with the computer science department, you know, that's something that, you know, would have been seen as very odd a couple of decades ago. And I had dinner with one of the first graduates from that program, and she was going to work for marketing at Microsoft, which is, you wouldn't associate computer science with marketing, and you wouldn't associate Microsoft with University of Chicago. But of course, you know, the CEO of Microsoft is Satya Nadella, one of our graduates, and of course, as we heard earlier, Hugh Johnson is on the board of that organization. So there's really been this very strong movement into technology, and you know, for example, in marketing, marketing used to be seen as sort of relatively soft. Now marketing is data analytics and machine learning. There's nothing more, nothing less to it. It's primarily that. It's just been a complete transformation. We see this also in the executive MBA program. The same trends that Madhav was talking about much more of a focus and interest in things like entrepreneurship than there had been from before. A strong interest in social entrepreneurship also than we'd had before. We are seeing the same kind of trends in the US, a very strong demand for the executive MBA program. The executives tend to be a little bit older. They're in their late 30s, early 40s, and they really want to be able to pivot and transform where they're going, either in the organization or to move to a different career. And that's been a very interesting transformation that's happened over the last decade. Before that, two decades ago, most of the students were sponsored by their corporations to move up in into the C-suite. Now there are far fewer of the corporate sponsorships, and many of these are being self-financed for people either that they think this would be a good boost, or they want to move on to something else, and especially in entrepreneurship. Obviously, there are some more challenges globally than in the U.S., but we are, here in London, we are making good progress on the virus, and so I think we're going to be able to put together a very robust class from the UK. But there are many countries that are facing more of these challenges, and that's going to pose a little bit of a challenge for us in the short run. The big positive is the technology that Madhav was talking about. We've been able to bring in so many more alums, do so many more engagement activities than we had before. So many more talks with faculty, and that has been really great for our engagement with you and with others, and building the networks with the students, because they now connect with people. We just had a great discussion with the CEO of Santander, one of the largest banks in the world, who was the first graduate of the first class of our executive MBA program when it was in Barcelona. And so we've been doing a series of talks between the faculty members and graduates that we otherwise would be impossible to organize. And the theme has been around the classes, because when you take classes, sometimes you're scratching your head and thinking, is this really going to be useful to me? Is this going to be helpful to me? A bit like what Hugh Johnson had said. Jim Laurie said, well, it's not always going to be useful immediately. It may be sort of the way of thinking. But what we can do is we can bring graduates in and say, this is totally transformative for me. This helped my career. This really showed how Booth ideas can move into practice. We had a great session with Mary Furto, who's the Chief Marketing Officer of Honeywell, and JP Dubé, who taught her the pricing class. She totally transformed. She became Chief Marketing Officer in a year. She completely transformed what Honeywell was doing. They hadn't done the same thing for a century. but they hadn't used any of the data that they had. So it was, in some sense, simple, basic things from our point of view, but totally transformative. And she was also amazing because in that same year she had a baby. So she had an amazing work-life practice balance, and was totally transformative. But I want to focus on this technology going forward, because you briefly mentioned it at Madhav. How do you see this working? Because you said that we've moved more in the experiential direction, and of course, many people feel that it's a challenge to have as much of an experience over the over Zoom or other technologies. So how do we make up for that experience through Zoom, or can we make up for it with technology? And how can we use technology to actually enhance some of those experiences going forward?
Yeah, I think so. I think the technology will play a very different role in our different programs. If I look at the full-time program, I think the notion of having students come have a 2-year immersive experience, I don't think that's going to change. So in that world, where technology will play a role is in enhancing the way we teach in class, right? So I don't think we'll have, if I take accounting, which is a class that I used to teach, going through a faculty member doing three-hour sessions of talking about the basics of accounting, I think those days are over. A lot of that content, I think, can be put online, can be made in sort of bite-sized doses that students read ahead of time and come to class and then have a much higher level discussion about what do the numbers actually mean? How do you communicate them to investors? How do you use them in making decisions, about investments? So I think the nature of the class in the full-time program will shift to become much more higher level discussion oriented than nuts and bolts. So I can think of financial accounting as one class that is ripe for disruption that way. My colleagues may not like me saying that. I can think of statistics as being another class that's ripe for that. I also think microeconomics, and again, I know there are people who would hate me for saying it. I think a lot of micro stuff can be put online and done in a very good way. So I think that's how the full-time program sort of changes. The other program where technology, I think, makes a big difference is our weekend program. So as many of you know, we had a very robust part-time sort of evening program in Chicago for many, many years, right? And that program, as Randy was saying, a lot of the companies used to sponsor people to come to that program in the evenings, the banks in particular. That model has gone away, right? So the evening program now is a fraction of what it used to be in its heyday, right? I think the peak was like 2006, just before the financial crisis hit. But that's been supplemented by this weekend program where we have students who fly in every Friday. Texas, for example, is a big market for us, right? Houston, Austin, Dallas. So we have a lot of people who would fly up on a Friday, take classes at Gleacher, Friday, Saturday morning, Saturday evening. So during the pandemic, the demand for that program has actually jumped significantly, precisely because a lot of the classes that those students were taking, they're able to now do it online without having to fly into Chicago, right? And so even though they're not getting the sort of full in-person experience, they're avoiding the friction of flying. And so I think that they're willing to make that trade-off. I think they would happily give up, the sort of in-person part for a bit in order to avoid having to do the flying in and out of Chicago. So that's a program where I see technology playing a much more significant role. The pandemic essentially forced us to do experiments which we would never have been able to do otherwise. So we literally, in the space of 1 week, shifted our entire teaching last spring from in-person to online. I'm very proud of the fact that we did not cancel a single class last spring. Every one of our faculty members decided to make the switch, made the investment and did it. And they have now learned over the past year. So a great sort of data point is that when I speak to our students, they don't complain about the teaching at all. They feel like even though we've been doing it pretty much remote with a few exceptions, our faculty have been able to hold them accountable, have been able to engage them, and make sure that they actually learn all the content. So I think it's been a very successful experiment on both sides, that our faculty have learned how to teach and learned how to teach sort of well. And now the decision we'll have to make, to Randy's question, is how much of that do we do in, say, the weekend program? If we have 20 courses to graduate from Booth, what is sort of the maximum number of classes that we will want to offer that you can do online versus what you do in Chicago? And when they do come to Chicago, do you do it more as an experience where they come for 2 weeks in the summer and they do sort of, a lot of stuff together, right? As opposed to this constant flying in and out every week. So we'll have to think through just what the model is for engagement in a world where more of the content is going to be delivered in sort of this siloed mode, but then how do we bring them together? And so those are things we're thinking about. Starting this fall, for example, the university has gone to this new calendar. We'll actually have 2 or 3 weeks open in September before classes actually begin. So we're trying to think about, well, is that a great way to bring together the part-time students, build that booth community across them in a concentrated way, while using technology during the year to sort of do classes. The other interesting thing I'll point out is in the winter quarter, when I would do student town halls, I would ask them, where are you? And very few of them are in Chicago, right? So somebody was in Virginia, somebody was in Toronto, somebody was in Colorado. So, you know, we may take advantage, if you will, of the Chicago weather to say in the winter, you don't have to be in Chicago. You can be wherever you are and take your classes, and then we'll do in-person classes in the autumn and spring. I mean, as sort of an extreme measure.
Yeah, I think, and what's great is we can learn from across the programs, because the executive MBA program had always brought all of the students together from our campuses in Hong Kong, London, as well as Chicago, together in the summer for these intense weeks for the electives. And so perhaps we can learn from that to use that as an engagement mechanism for these other programs. So it's also been helpful to kind of think across the programs. Obviously, we've needed to use technology a lot because of all the travel restrictions and trying to get people flying into either our London or Hong Kong campuses, and also given the travel restrictions that we've had there. And it really has been amazing, because I've been teaching for more than 30 years here at Booth, and the only innovation that has occurred, the technological innovation in that 30 years before this past year, was moving from chalkboards to whiteboards. That was the level of innovation that we had. And then, exactly as Madhav said, in a week, we went in a completely different direction. It was really quite amazing. The faculty were really very supportive of that. And I think that's been crucial. We're also doing that in non-degree executive education. And as you know, we have this group has been extremely helpful in putting together the program for emerging CFOs. We will be running that online for the first time in May. So as always, I ask you to think about sending people that you know, some of your direct reports who you may be grooming as to move up in the organization to do that. I'm also going to be doing online the so-called high stakes decision making and strategy program. This is something new that we have innovated, which is very much along the lines of what Hugh Johnston was talking about, because how do you sort of think about the response to a shock? How do you prepare for that when you don't know the shock itself that's coming? So breaking these very complex problems down into things that you can control for, and then when the shock comes, you haven't predicted the shock. That's, I think, a fool's errand to try to predict events that don't occur very often. You just don't have the data to do it, but you can still be prepared even if you didn't know the particulars of the shock that were coming. And so we're sending out the links in the chat for those. I think that's something that's really transformational, and we're engaging there.
So Randy, there was a question which from Mike Van Atter about the online instruction and how does that affect the size of the student body. I think the full-time program, in my view, is pretty much at steady state in the sense of just the, and that's dictated, frankly, by physical constraints. At Harper, we take 590 students in the full-time program. I don't think we're going to change that sort of significantly. If you look at the total number of students we teach at Booth, interestingly, that number peaked back in 2009 or so. And since then, it's been sort of decreasing, largely because, as I had mentioned, the evening program has shrunk at an amazing rate, right? It's kind of like 30–40% of what it used to be. The weekend program has ticked up, right, and has taken some of the slack, but overall, we teach fewer students now than we did 10 years ago. So with technology and increasing the number of students who would get into something like the weekend program, I expect the number of students to go up, but I don't expect it to ever sort of crest or go above the numbers that we used to teach before. We would rather use technology as a way to, as Randy said, do non-degree executive education. The other thing I want to think about is using technology as a way to give content to all of you, to alumni. With online, for example, right, sort of the marginal cost of having one more person is zero. So if we're doing a class that is online, one of the things we experimented with last summer is opening it up to alumni groups and saying, hey, if you want to take that online class, go ahead and do it. And so this, it's been a great way to sort of try to engage with alumni, both using small events, as Randy mentioned, with faculty discussions, but also trying to take the content we would produce anyway as faculty and then trying to figure out an easy way to distribute it to all of you. I'm very hopeful that actually alumni engagement is something that's going to go up significantly, because we will use technology as the platform to disseminate the things that we're working on. And so that's something that I'm quite excited about.
Yeah, and we have an excellent event coming up by one of your colleagues, the CFO of Moderna, which has obviously been transformed. The company has been transformed, and that company has helped to transform our lives around the world. That's coming up on March 17th, and we just put in the chat the link to that. We already have, I think, more than 2,800 people signed up from around the globe for that. I think it's going to be a lot of fun. I'm going to do a fireside chat with him. It's called the Vaccine Revolution. How did it happen and what's next? And so he'll both talk about the transformation of Moderna. As he said, he joined just a little bit more than a year ago, and they had zero revenues. And they'd had zero revenues for many years before that. They have $18 billion of revenues in a year. How do you deal with something like that? That's going to be, I think, just a fascinating discussion. And it'll also have some health tips on, what sort of vaccine to take, whether the vaccine is effective or not. So there are always a lot of questions about that also. So I think that should be quite fun. But we've been able to do a lot of content that way, and I think, and we've been able to bring people into exec ed, into our regular classrooms, also from the alum base. It's really been terrific. Students still clamor to get back together, especially in the executive MBA program, and we will be doing our darndest to bring them together. But classes are likely to have some hybrid character to them going forward, because many countries still have travel restrictions or have very long quarantines, and so it may be a challenge going forward. But we've figured out how to connect more people, to get more people into or get more of our alums into the classroom and connect with them. So does that make up for it completely? For sure not. Is it something that's new and that we can use going forward and will benefit us and make us a better, stronger program going forward? For sure, I think.
So a couple of questions, Randy. I'm happy to pick them up. First of all, thank you to Mark. I think that this is something, again, you think, well, duh, why didn't you do it before, right? Well, you need a shot to make you think about regular things a different way. And we've started doing, distinguished speaker series events. We used to do one a quarter. Now I do sort of one every 3 weeks. Interviews with faculty for alumni, giving more content to alumni. Again, we should have probably done it before, but we're doing it now. And so thank you. In terms of value of the booth content, I'm not worried about that. I mean, I feel like what booth is great at is having the best faculty in the world to come up with sort of original ideas. And I want to sort of distribute it as broadly as I can, touch as many people as possible. So I'm not really worried about that. I think going back 3 to 4 years, our faculty would have been much more worried about the IP of their content and stuff like that. They don't really worry about it as much anymore, because they see the value of getting their brand out there and the Chicago booth brand out there. And they feel like that outweighs sort of any particular IP they may feel, belongs to them. And to be honest, right, I mean, we're not like a science school, right, where you have specific IP that is patentable. And so we're less worried about those kinds of issues. So the goal is just, again, get our best faculty out there in front of all of you and the world as much as we can. And the faculty have been great. I've not had a single faculty member turn me down into to doing a session with the alumni. So our hope is to just keep doing as much as we can.
And also, this has actually been transformative for the way the faculty do research. And so in the first few months of the pandemic, rather than people just kind of going duck and cover, the production of research that was relevant for the pandemic was just absolutely astonishing. And also what's amazing is the availability of data from SafeGraph and other sources, where you can, within with no more than like a week lag, you can figure out from cell phone data where people are going, where they're not going. And so there was an incredible amount of research that was done, immediate research within weeks of, well, what's the impact of imposing a travel restriction? What's the impact of imposing these different lockdown restrictions? very clever work being done on the border between Illinois and Iowa on exactly that issue. Illinois imposes one restriction, Iowa doesn't, but the Cedar Rapids market is all one market. So you can see you can see what the impact is. So it was just astonishing to see how quickly faculty could move to address super important issues. And then through exactly what Madhav was saying, we got that out there by posting it, by having different events. It's really been wonderful and exciting. So thank you so much. Thank you, Madhav, for coming to join us and giving your insights. I think that was really, really valuable. Thank all of you for coming to this virtual event. I hope you found it worthwhile. We really want to get your feedback. We tried to make sure that it would engage you. I know it's always difficult to engage over 3 hours, but you can see the type of learning that we have. We try to break it up with breakout rooms, discussions, fireside chats, and different types of presentations. So eagerly looking forward to your feedback, and eagerly looking forward to seeing you hopefully in person, but perhaps in a hybrid format in the coming year. Thanks so much.
Thank you, everyone.